Welcome to the WealthWise Show, where financial success meets informed decisions. I'm your host, the Wise Investor, and I'm here to guide you through the fascinating world of finance and help you to make wise choices. Join us as we unravel the secrets of smart investing, effective money management strategies, and the different realms of financial education. Remember, the information provided on this podcast is for informational purposes only and educational purposes only. Always consult a financial professional before making any major financial decisions. Now let's start the show. Alrighty, guys, welcome to another exciting episode of the WealthWise Show. I appreciate you guys listening to me for, I don't know how many episodes this is now. I think 24. And today, since it's our 24th episode, I got nothing special because it's only 24. But I do want to talk about something that is very important in today's time and very critical in today's market atmosphere. And that is inflation. Now, I've dabbled in inflation a little bit before and talked about it a little bit back in the past. But one of the key things that I want today's episode to be about is how to protect yourself against inflation. And most of the things that I'm going to suggest typically going to be things that most people know, but a lot of people who do tune into the show are not super savvy in the markets, which there's nothing wrong with that. I'm actually going to do an episode about institutional investors and retail investors. So there's nothing wrong with not being savvy in the markets. You know, I know some people want to make others feel stupid. That's not my goal here. My goal is to, like the title of the show, present wealth wisdom, essentially. So I'm going to talk about I'm going to have a few things to talk about when it comes down to hedging inflation. Now, hedging is important in everything, in life, in the markets. You know, you can use it for anything, and all hedging is I would say, let's put it as in protection or insurance. So in life we have health insurance. You know, when we have a car, it's auto insurance. In the markets, you have different ways to hedge. Your portfolio, so that way if something were to happen, you're not out on the street. So there are many different ways to hedge against inflation, though. So one of the things that I wanted to bring up is the definition of inflation. So basically, inflation, how it works is it measures how much more expensive a set of goods and services have become over a certain period of time. So, as in the words of Fat Joe, yesterday's price is not today's price. That's inflation. You might notice it in food costs is going up, housing is going up, daycare is going up, everything is just going up. Even wages are going up. And rents are going up. So that's pretty much inflation. Now, inflation is typically something that's going to be stuck with us for life. As long as there's a monetary system, you're going to be stuck with inflation. But the point is not to have inflation rise to at a rate that is jarring for the constituents. So if you are noticing yesterday you paid $2 for eggs, but today you're paying $8, that like, what in the world happened yesterday? And so typically how the federal government wants to work, or how most governments work, is they want to keep prices going up, but they want to keep it at a rate that is conducive to people's mental health. Just put it simple as that, because once people start seeing prices going up as quickly as it is, now it becomes a political topic. But just know that inflation is always going to be there. But when we have, like we currently have, super inflation, where things are just going up day after day after day, you need to be able to protect yourselves against such things, especially if you have a equity portfolio. So if you are invested in equities, you're not just invested in equities, almost anything. The rate of return should outpace the rate of inflation. That's the goal here. And if the rate of returns is not outpacing the rate of inflation, then that's going to lead into a problem, because what's going to happen is you're going to have purchasing power. Your purchasing power is going to diminish, and your investment value is going to diminish. So like I said in the analogy of the eggs, if eggs were $2 yesterday and you made $2 an hour, but now eggs are $8 today and you still make $2 an hour, you see how you can buy eggs now. So, protecting against high inflation like we're in is really important. So those are the two important things I want to talk about, or I'm going to help with: protecting purchasing power. Purchasing power means, the power to purchase things. Like I said in analogy, you could buy eggs yesterday, but now you can't. Investment value. So if you have a equity portfolio and it's not keeping up with the rate of inflation, the value of that portfolio diminishes, no matter if, it's going up or not, because it's not making enough to compete with inflation. So some of the things that you can do to protect against purchasing power diminishing is, keep in mind, guys, I know it's in the intro and I know I say it like 100 billion times, but please, this podcast is for educational purposes only. So anything I say going forward is strictly for educational and informational purposes only. I'm not telling you to do these things, so please don't listen to me and do these things without talking to your financial professional. But one of the things that you can do to kind of help combat high inflation is reallocating money into equities. Like I said before, and I know you might be saying, well, Derek, you just said if you put money in equities, if you're just not keeping up. Okay, yes. But typically, equities do can compete with inflation. That's typical. Now, we did have some issues whenever this time this podcast came out, 2022, we did have some issues there. But if you look at the markets in 2023, it's doing better than inflation. So there are, typically in the long run, equities usually can outpace inflation. And the thing about inflation and bonds, I know I'm a big lover of bonds because I love safe yields, but inflation can diminish the value of bonds. I would say typical bonds, because there are other bonds that compete with inflation, but usually the bond market is taking a hit because everything works off of interest rates. So if inflation is going up high, you're going to have a situation where the federal government is going to want to combat that, because now it's just too jarring for people. So they're going to have to keep people from spending money, because that's exactly what causes inflation. So let's say, for example, if you own a Apple store or Apple shop, not like an Apple store like the company, but like the fruit. If you own a Apple stand at a farmer's market, and you at one point had 10 baskets of apples, and not a lot of clients or not a lot of people came to buy your apples. Of course, you're going to do sales to try to get interest. You're going to lower the price. Now, let's reverse it. What happens when you have one basket of apples and you have 1,000 people coming to your stand to buy your apples? Well, you're going to be like, hey, I don't have enough for everybody, but I need, this is all I got, and I can't let this opportunity go by. You're going to raise the price. So inflation is the same way. We got into inflation because, people had way more money to spend, and then there was way less supply out there. So the supply and demand ratio was skewed. And when you have things, when that happens is the federal government have to sometimes raise rates. And when they raise the rates, that affects the bond market. Why does that affect the bond market? Because the bond market works off of interest rates. That's how you get paid when you purchase a bond. You get paid by interest. But if you get, let's say you get a bond with 3% interest, and the federal government says, hey, we're going to raise rates up to 5%. Now the value of that bond diminishes because people can just go and buy new bonds that are, coming out at 5%. And that's not exactly how that works, but that's as much as you're going to get from me in a 20 minutes time span. So effectively, now your bond looks less attractive. So like the analogy of the apples, the price is going to have to get lower if you want to sell that bond. If you want to not hold that bond to maturity and you have a lower interest rate bond and interest rates are higher, you're going to say, hey, I will give you this bond at a discount. So that's why the bond market goes down when interest rates goes up, because the current bonds that are issued at a lower rate than the new bonds that are currently being issued. Hopefully that makes sense. So reallocating your money into stocks versus bonds is typically a strategy that you can use to combat inflation. You can reallocate a portion of your bond holdings to equities. Now you have things like preferred stocks. Preferred stocks is similar to bonds, except it's more of an equity product than a debt. Well, it's still a debt product. It's basically a mixture of a bond and a stock. It's going to take longer than 20 minutes for me to explain preferred stocks. I might do an episode on that one day. So preferred stocks is shares of a stock that you buy from a company, and they pay you interest rates instead of you getting like, I guess, like a regular stock movement. So it's a lot more safer essentially than a stock. You really don't participate in the gains of the stocks or the regular equities because you're getting paid a interest rate. So you can purchase preferred stocks. You can do utility stocks, which is typically companies like, for utilities, and they pay dividends and things like of that nature. And you can buy a few alternatives, which I'm going to talk about in a second, to help benefit during inflation times, high inflation, not just inflation, but high inflation. You can diversify internationally. Now you might say, well, how do I diversify internationally? Well, if America is having high inflation here, now let's say we go in cycles, and the cycle for high inflation is here, and other countries are having, let's say, for example, great inflation. Like, it's not that things are not as bad. That's a fairy tale, but just entertain me for a second. And you find that, hey, these other countries, they're doing pretty well when it comes down to their equities and bonds and things like that. Well, you can purchase those things to help combat inflation here, or hedge against inflation here. You can increase your international exposure. Now, the thing about increasing international exposure is there are some downsides to international exposure. Mainly, the biggest one is you don't live there, so you really don't know what's going on there. The news that you get here could be fake news. You don't know the laws there. The laws, America is very good at, being friendly to corporations. Whatever country you're investing in might not be as friendly. So there's a lot of more details and research you have to do to, if you're going to invest in internationally. But you can use ETFs. Now, remember in my episode a couple of episodes ago about ETFs and mutual funds? Well, you can use ETFs for a low cost diversification in international market. There's tons of funds and mutual funds, or ETFs and mutual funds, that have exposure to international markets. So therefore, they do all the research, and you can still benefit from that exposure. ETFs is going to be one of the key things in this episode, because they can be really good for newer investors who are, this is not your job. Like, this is my job, so I love it. I do the research, I read the reports, but this is not your job, and you're not trying to take on a second job just for investing. So ETFs are typically something that you will look into. And you can also move it on. You can also consider real estate, because real estate is a tangible asset that has intrinsic value and consistent income. And when I say real estate, I mean rental properties, essentially. That can help. Now, of course, property values may go down depending on the interest rates, but if you have rental properties, you're getting a consistent income. And like I said, rents are going up. The inflation for rent is going up. So if you're renting, and typically rent goes up every year anyways, so the next year you charge an additional $100 to kind of help keep up with inflation. Now, if you don't want to go out and buy the physical properties, I talked about this in the last episode. REITs is another form of investing in real estate. It's more liquid, and I love liquidity. So, if you can get the same benefit and the same, outcome, but keeping your assets liquid, I'm all for it. So you can look into REITs for your real estate needs. And then you also got, other ETFs. So there's one. Now, this is not an endorsement or anything like that, but I'm not even going to say the name, but there's tons of ETFs out there and REITs that have exposure to real estate. Now, I know I said bonds is, typically do bad in inflationary times, but there is a debt security that you can use to kind of help combat inflation. And it is called the Treasury Inflation-Protected Securities, or TIPS. TIPS. So TIPS are pretty much a treasury, product, or I would say it's a treasury security that allows the person who purchased it to help combat inflation. So how does TIPS work? Essentially, if the rate of inflation is going up at the next CPI report, for example, then the interest rate on your TIP, the interest rate on your Treasury Inflation Protection Securities is going to go up. So it kind of keeps up with inflation, essentially. There's different frequencies. You got 5-year TIPS, you got 10-year TIPS, and 30-year TIPS. But and the thing about, by the way, bonds that I like is bonds don't have state or local taxes. They are federally taxed, but most U.S. Treasury, that's when I say bonds, I'm talking about U.S. Treasury. So bonds that are issued from the U.S. government typically don't have no state or local taxes, but you still got to pay federal. But like I said, it keeps up with inflation because when the interest rates go up, it goes up. Now, the same thing can happen though. That's why TIPS is typically a hedge, because you don't always keep a hedge on. Sometimes you take your hedge off, put it on, take it off. So if you own TIPS, the reverse can happen. So if the interest rates starts to go down, well, the tips can go down as well over his term. So they can go up and down. The principle of the Treasury Inflation-Protected Securities can go up and down. So I personally would definitely, if you're going to do that, talk to your financial professional, because yes, inflation is going up now, but it's already gone up and it's starting to come down. So talk to your financial professional and see if this is a ideal product. So the next thing is buying bank loans. What in the world? You mean go to the bank and get a loan? No, that's not what I'm saying. You can actually, like I said, you can purchase debt. Like the people, can purchase debt. Now, buying secure or senior secure bank loans is a little more sophisticated for most retail investors. So that is something, if you're savvy and you got the resources, and it fits your goals, talk to your financial provider or professional financial professional and see if that works. Hey, have at it. But for those who are, like I said, are more, this is not your day job, essentially. You're just doing this because you want to help build equity and retirement and all that good stuff. So once again, you can do ETFs and mutual funds. There are mutual fund and ETFs that, pretty much do what I just said. You have Invesco senior loan ETFs. Now, like I said, they're not endorsing me, do your own research, blah, blah, blah. But I shouldn't say blah, blah, blah. Please, guys, research this stuff. I'm just a voice in your head, or a voice in your earbuds. I'm not in your head. Oh my goodness. Anywho. Invesco senior loan ETF is an example. You can go and look and see what the returns are, the yields, and things like that. So you can invest in, more debt, but you're the creditor essentially. And as things the reason why I like ETFs and mutual funds, it keeps your assets liquid while still getting the benefit. So that being said, I want everyone to understand that historically, the best hedge against inflation is equities. It just is. As a long-term hedge, investing in equities, stocks, and things like that, historically have been outpacing inflation. Now, you might have a couple of a year or two like we did in 2022, but if you look at the overall history of the track record of inflation and the markets, the markets have outpaced it. So also understand, if you do have real estate, you can use it. You have the ability to, it has this ability to hold value, and you can increase the rents during inflationary periods. And there's all sorts of ways to be the creditor, essentially, by buying tips. You can do that. And if you hold to maturity, bonds are still great. Now, I know the bond market can go down and things like that, but the principal does not go down. I want to emphasize that. So if you bought a bond and you pay $1,000 for that bond as a U.S. Treasury, you're going to get that. Doesn't change. Even if the market goes down, the bond market goes down or whatever, as long as you hold until maturity, you're going to get your $1,000 back. Now, you lose money when you want to sell before maturity. So let's say, for example, I don't know, inflation happened, they raise rates, you have a 2% bond, and now you can buy bonds at 5%. So, your $1,000, if you want to get out of that to reprice to higher yield bonds, you might have to sell, at $800, $700 to get out of that bond so you can go with a higher yield. But it still doesn't change the fact that if you held until maturity, then you would get your money back, your full principal back. So there's all sorts of ways to mix and match and, hedge inflation, combat inflation, and things like that. So understand that it's very important that if you're an investor, you hedge against inflation, even the small inflation that's goes up without everyone knowing. And it's really important to understand the different asset classes and how they can protect your portfolio during inflationary periods. So go ahead. This is a 20 going on 30-minute podcast. So there's not much I can teach you in that time, but go out and do your own research. See what asset classes might fit your portfolio, your needs, and things of that nature. So understand, guys, it's important to always ask questions. It's important to hedge, and it's important to make wise decisions. So that's going to be the end of today's show. I hope I imparted some wisdom. Please, if you like today's episode, like, comment, subscribe. Wherever you're listening to this podcast, leave a positive review if you're feeling positive. And if you're not feeling positive, kind of keep that to yourself. So it's been another great one. I appreciate you guys. And until next time, stay wealth-wise. Investment advisory and financial planning services offered through Simplicity Wealth and SEC Registered Investment Advisor. Sub-advisory services are provided by Simplicity Solutions, LLC, a registered investment advisor. Any insurance, consulting, and education services offered through the WealthWise Show. The WealthWise Show is not affiliated with Simplicity Wealth and Simplicity Solutions.